You've got cash sitting in your checking account doing absolutely nothing. No growth, no purpose, just sitting there. Today we're breaking down the three main places to park short-term savings so your money is actually working while staying safe and accessible. A lot of people keep extra cash in a regular checking account because it feels simple and safe. The problem is that regular checking accounts typically pay little to nothing in interest, so that money is quietly losing purchasing power over time due to inflation. The good news is there are several low-risk, insured options that let your short-term cash earn a return without taking on real investment risk. Let's look at the three big ones. A high-yield savings account works like a normal savings account, but typically offered by an online bank or a bank's online division, with a much more competitive interest rate than a traditional brick-and-mortar savings account. Your money stays liquid, meaning you can generally transfer it out whenever you need it, though some accounts may limit how many withdrawals you can make per month. The rate isn't locked in. It can move up or down over time based on broader interest rate conditions. This makes high-yield savings a strong default choice for things like an emergency fund, where you want your money safe, insured, and accessible without much friction. A certificate of deposit, or CD, is a bit different. You agree to leave your money with the bank for a set term, that could be a few months or several years, in exchange for a fixed rate for that entire period. The trade-off is access. If you withdraw the money before the term ends, you'll typically pay an early withdrawal penalty, often calculated as a forfeiture of some amount of interest. CDs make sense when you have a rate you're comfortable locking in and money you're confident you won't need before the term is up, such as savings earmarked for a specific future expense. A money market account sits somewhere between a savings account and a checking account. It often pays a competitive rate similar to high-yield savings, but may come with check-writing privileges or a debit card, giving you a bit more flexibility in how you access the funds. Some money market accounts require a higher minimum balance to earn the top rate or avoid fees, so it's worth reading the fine print. Functionally, for many savers, the choice between a high-yield savings account and a money market account comes down to which features and access methods matter most to you, rather than a dramatic difference in safety or return. All three of these options, when held at a bank, are typically insured up to applicable limits by the FDIC, or by the NCUA if you're using a credit union. That insurance is a big part of why these are considered safe places for short-term cash, as opposed to investing that money in the stock market. The safety comes from the insurance and the structure of the account, not from any single institution's marketing claims, so it's worth confirming any account you open is properly insured before depositing funds. The real decision framework here isn't about finding the single best rate advertised somewhere. Rates change and vary by institution. It's about matching the account type to when you'll need the money. If you might need funds at any moment, like an emergency fund, prioritize liquidity with a high-yield savings or money market account. If you know you won't touch a chunk of money for a defined period, a CD lets you lock in a rate for that stretch of time. Mixing strategies is common. Many people keep a liquid cushion in savings while placing money for known future expenses into CDs. One approach worth knowing is a CD ladder, where instead of putting all your money into one CD term, you split it across multiple CDs with staggered end dates. As each one matures, you get periodic access to a portion of your cash, and you can choose to reinvest it or use it, rather than having everything locked up at once. This can be a useful way to capture the fixed-rate benefit of CDs, while reducing the liquidity trade-off that comes with a single long-term CD. There's no single right answer here. The best choice depends on your goals, how soon you might need the money, and how much flexibility matters to you personally. High-yield savings offers flexibility. CDs offer a locked-in rate in exchange for reduced access, and money market accounts often blend features of both. Before opening any account, compare current rates, minimum balance requirements, and withdrawal rules directly with the institution, since these details vary and change over time. That's the real breakdown of where to park short-term cash. No hype, just the trade-off so you can decide what fits your situation. If this helped clarify things, subscribe for more videos breaking down everyday personal finance decisions in plain language.